Hello, Mark Sturdy here with highlights of 7 days ahead's weekly technical analysis, week beginning 11th of January. Well, since we last wrote, things have changed. We have become very interested in the bond markets. You see here we have the German and the US bonds we both think are very bullish for higher yields, and that is new. Otherwise, there's not a lot changed. We have now pulled back from our bullish position in the S&P. We're a bit suspicious of what's happening there. We don't know what's happening, and and of course, what happens there tends to influence the rest of these. We remain bulls of the dollar, particularly against the euro, and against the yen, less so against sterling. Let's quickly look at that. There's the big picture, the double failure there, the bear market of the euro. Closer inspection, that's revealed being driven by a complex double-headed head and shoulders top, and we think it's going to go to 109. At the moment, we remain within a continuation triangle, but with every expectation that it's going to break on the downside. Dollar sterling is rather more difficult. It's sitting on support here, so sterling is not weakening like the euro against the dollar. It's in fact a small bounce. So much so it's bounced up through this resistance. It's quite a creditable performance. In the very short term, we've got a nice little rally going on in sterling. So we're standing aside from sterling, but we remain bearish of the euro and the yen. Very quickly, the yen, we have this big bull continuation for the dollar. There's the medium term, breaking up through the prior high, having bounced off the smaller wedge shape or rising wedge. And in the very short term, we have them break up through 115.51, finding support there. So immediately, you might even say that the yen is the better sell against the dollar than the euro, but they're both pretty bearish. What's happened to the S&P 500? We have been bullish for quite a while. There's the long-term chart. Here is the weekly chart. We had a weekly key reversal there. We've had two weekly key reversals. Seems to be a slight accumulation of bear evidence there. We haven't broken back through the medium-term support of 45, 49. That would be the likely next move, it seems to me. Short-term also bearish. The market got up and stayed above initially the prior high of 47.05. It was also the top of a triangle and then collapsed back into it. That's not good. So we've pulled back from our bullish feeling about the S&P. Let's move to the bonds because we're excited by those now. And what we're really excited by is the confirmed breakup through the resistance to higher yields by this move here, push up through. This was massive resistance. We broke up through it, then the market flakily drove back down through it, and now it seems to me, unambiguously pushing through it. We're doubly encouraged because we think it's the completion of a bull continuation triangle at the end of last week that sees yields going up as far as at least 2.3 minimum. That's quite a move. And quite a move that's yet to happen. Here in the price chart, this is the yield chart, price chart, we see the breakdown through the sideways consolidation since middle of October. So now if the market tries to rally, it's got massive resistance above it. That is bullish for higher yields. Same with the Bund, very quickly. The Bund is broken up through prior highs. So whereas the market's failed to establish itself above this big resistance here, we think there's a strong argument that it's now done that, with the unambiguous break and close above that level. This is the, in price terms, of course, it's been a bear market. Cautious bears might want to wait for a break beneath 169.34. Others will be right on in there in any event. And that is that. Those are the clear positions we're seeing. There's a lot more discussion about oil and gold, but none of that is a clear-cut buy or sell. Thank you.